Well, thank you everybody for joining us. I'm Michael Thompson from Copperleaf Financial here in Vermont. And today we have special guests, Sam Adams and Larry Swedroe, talking about their new book, Your Essential Guide to Sustainable Investing. And we actually have a Copperleaf version. I was proud to be able to write a foreword for our version, which we have some copies available for folks who are interested in learning more about sustainable investing and really digesting the fantastic content here. So here's what the cover looks like, and let's get into our conversation today. And again, thanks everybody for joining us. Just a couple of housekeeping pieces. We are recording this call, so within a week or so, we'll be posting this on our website. So you'll be able to see it there or share it with your friends. We appreciate that. And we take questions today. So any questions that you have, please go ahead and enter them in the chat, and we'll get to those as we go. By way of introduction, Larry Swedroe is the Director of Research at Buckingham Partners, and one of our partner firms. And we like working with Larry, worked with Larry very much in the past. And Sam is the CEO and one of the founders at Vert Capital. Runs one of the funds that we use in our sustainable portfolio. And together these guys have come out with this new book. And I want to start by asking either of you guys, both of you, feel free to chime in. What was the idea? What stimulated this book, and what made you think about putting it together?
I'll just jump first, and then Sam can add on. To me, it was obvious watching the capital flows, Michael, that were rushing into sustainable investing. It really was a very minor trend, sort of like indexing was when John Bogle first came out with his first index fund. Very slowly you saw interest in it, word would get around, but it took a couple of decades really before you started to see like that hockey stick. And the same thing happened with what was originally, and Sam will talk much more about this, SRI, ESG, now sustainable impact investing, this whole movement. And that exploded around 2017, 18, and really rocketed up in 19, so the tunes of tens of billions every month. And I was getting lots more questions about it. And so, which is, as you know well, our view at Buckingham, when our clients want answers to questions, we don't want to give them our opinions. We want to give them the evidence from peer-reviewed research. So I started writing lots of articles about what the research had done. And then I said, well, we need a really good book, but I'm only an expert on what the academic evidence. So I turned to my good friend, Sam Adams, who I had known for probably 20 years through Dimensional. And Sam's background was in this whole history and why do people want to invest? So I'll turn it over to Sam and let him finish the story, how we connected and stuff.
There you go.
So Larry and I go back a long way. I worked at Dimensional Fund Advisors, a partner of Buckingham's, back, I was there for 20 years. So I knew Larry really well. And I was really glad to see, like he said, around the 27, 18, 19 time, that he was starting to review these academic papers and then publish in all the great writings that he does, the findings of the papers. That's Larry's really good at taking this really dense PhD dissertation or white paper and putting it in a couple paragraphs for investors to understand what the takeaways are, what the conclusions are, and what they might want to do with their own portfolios given those conclusions. Mm-hmm. And so I saw that he was writing about ESG, and I started, weighing in on some of the research with him. We started talking about it. And when he said someone needs to write a book about this, I said, Larry, you've written like 15, 20 books, go ahead and write it. And he said, well, I need someone who's an expert on sustainability. Of course, I've been doing that for full time for over 10 years now. So we got together, and it's been a great journey. I've learned a lot from Larry on how to write a book. This is my first one. And it's been a great partnership.
Yeah, great. Well, I'm so glad that you guys did get together because, it needed to be done. Having kind of one volume, one book that provides a guide for, the everyday investor, I think is really helpful. And so this is the official launch kind of month, right? When did the book start on sale? And I'm gonna
April 5th. So we're just 2 weeks out or so.
Yeah. So for those participating, here's what the cover looks like. And again, we have copies. We were able to get our own Copperleaf version, which I wrote a special forward to. So if you're interested, let us know. Follow up with us afterwards, and we can make sure you get a copy of the book. So it took you a while, I think, to put this together, but faster than I thought, because I started talking to you guys about this. Was it 2 years ago? How long did it take you to put it together?
We were able to do it fairly quickly because, as Sam had noted and I explained, I had written probably 50 or 60 pieces over the years on what the academic findings were. And Sam has been giving lectures and writing about the history of the movement and why people invest. So as a matter of us structuring a book and getting it done, and then each of us editing the other's work to make sure it was accurate and a consistent tone. And it was a real pleasure working with Sam. We got it done fairly quickly. Sam, what would you, about 6 months, I think, or so?
Yeah, and Larry's right. A lot of this, I don't want to say the information was already in the can, but a lot of the struggle that I had was deciding what to put in the book, because there's so much more there's so much more research.
Yes.
Larry really had to narrow down the papers that were included, and I could go on for days talking about the differences between ESG and SRI and impact, and really making it a 200-page book rather than a 1,000-page book was the challenge.
Yeah. Well, and one of the things I like about it is so current. So you guys have current data, current information in there, which is really, really helpful. We know how fast information flows and data evolves. So it's nice to have the current information here. Let's go back to the topic, though. And Sam, maybe I'll turn to you. The title of the book, Your Essential Guide to Sustainable Investing, you could have called it Your Essential Guide to ESG Investing or SRI Investing. Why did you land on sustainable, and how do you define sustainable as compared to some of the other phrases that we hear out there?
Yeah, that was a really difficult decision. I think one of the most difficult things was, what do we do with the title, right? Because there is no standard anymore in the industry on what we call this, right? And some people call ESG the umbrella term for all different types of responsible investing. Some people call it responsible investing. But I think there's if you look at it globally, sustainability is what the term is. And let's go back. The UN's definition of sustainability is meeting the needs of the current generation without compromising the needs of future generations. And so that's really encompassing, right? Not just the environmental side, but the social side and a whole bunch of other issues. And so if you look at it that way, that's kind of a good umbrella term. And we didn't want to use ESG and SRI and impact in that because historically anyways, those had very well defined terms. SRI was what we did for hundreds of years when we wanted to maximize return, but we wanted to kick out some companies we had problems with, like alcohol or tobacco or what we call sin stocks. Yeah. And ESG is very different. ESG is looking at the companies, not what my wants are, but what the company's risks and opportunities are, and evaluating those risks on an environmental and social and governance framework. Yep. And then impact investing is really a for-profit version of philanthropy, right? Sending in capital to a problem area or issue and trying to solve it, trying to move the needle. And so those historical definitions I like, because they still tell us a lot about the different styles and the different expectations and the different reasons for doing those. Yep. So that's why they're in the subtitle, right? How to use ESG, SRI, and impact. Yeah, well, and I appreciate it especially, and was so glad to see this
the title and the content in general. I think you guys did a fabulous job, but it also aligns so well with how we approach the same topic for our clients. We really think about the work that we do for our clients as not only sustainable investing, but sustainable planning, helping people really align their money with their values and make sure that over the course of their lifetimes, they're making the world a better place in their definition. And so I think that's really, really great. We love how that aligns with our thinking. I want to take a step back and just, if you, Sam or Larry, give us a little bit. Larry, you talked about the massive increase in flows from an investment standpoint into these types of investments over the last several years. But Sam, as you sort of alluded to, this has been going on for a long time. Can you just give us a very brief history of this type of investing? I mean, how did this whole thing start, and give us a kind of a picture of the evolution of this?
So one of my, well, there's a lot of favorite parts of the book, but there's an appendix that I lifted from our friends at C Note, an impact investing shop, that they wrote something about the history of SRI, and it goes back thousands of years, right, to like Hammurabi and, and religious investors from days gone by. And like I said, that was all about trying to maximize financial return, but not investing in things that you had an ethical or a dilemma about, or an issue with, an objection to. And in the US, we point to the Quakers often, saying, they exhorted their membership to not invest in companies that were profiting from slave labor, right? So this is, over 100 years ago in the US. And that form of investing was a small niche for the longest period of time. And then in 2005, the UN came out with some papers about the idea of incorporating environmental, social, and governance metrics into an investment management framework to better understand the risks that companies are facing due to climate change, to income inequality, to the treating people, all these things. And that really launched a new form of investing called ESG. And that had a slow start because people didn't really take it seriously. They thought it was like SRI. And then when the big institutional investors started investing it, 7 of the 10 largest pension funds in the world use ESG now. And when people started to see that their performance wasn't as a problem like they thought it was, it really just took off, as Larry said, in 2017, 2018, and through now. So much so that it's a third of all professionally managed money in the US incorporates some form of sustainability criteria, and the estimates that are in Europe, it's about half.
That's really impressive. And we've watched that too over time. And, we've been interested in it, and I've followed it for a long time, personally, invest that way. But yeah, it's been amazing to see the change in the environment. And I wonder what impact that might have on the sort of the future from an investment standpoint. And Larry, maybe you could talk about this. I think, there are other topics we want to cover around performance, but do you think, is there, sometimes I think when a space gets kind of crowded, it may impact the performance, but maybe I'm wrong. Is there any downside to so much money going into these investments?
Michael, you wrong? That can't be. But this is a really interesting and an important question. We spend a lot of time in the book trying to address that. So let's begin with simple, where I always like to begin with, what does economic theory and logic tell us? And then we see if the evidence lines up with that theory. And by the way, Gene Fama, one of our great financial, if not our greatest financial economists, taught me, if your theory doesn't align with the data, you don't throw out the data, you throw out your theory.
Right.
So we want to we always present the theory, and then we look to what the empirical evidence shows us, and we do that in the book. So the economic theory is very simple. if you have, let's use Sam's example of the sin stocks, which was the way SRI really was until about the last 20 years. And so you had the category of the sin stocks: tobacco, alcohol, gambling, maybe defense, and pornography, maybe. And so if you had enough people screening those industries out, right, they wouldn't buy them, then you don't change their earnings, which is really sort of a problem in some people's minds. You're not hurting the company's earnings. You do that by not buying their products, but you do affect directly their cost of capital. They have to pay more for their debt, and their PE ratios are going to be lower than the companies who are favored because they're good citizens and more cash flows into them. So call them the green stocks will have higher PEs, lower interest costs, and the brown or sin stocks are going to have lower PEs and higher debt costs. And that's exactly what the evidence showed. We showed a couple of studies. One was called the Vice Fund that looked at long history of, if you exclude these stocks, how would you do? Well, a Vice Fund that only bought those stocks, sort of the anti-SRI, outperformed by 2.5%, 3% a year. And so theory held up with the logic. Now let's see what happens when we get to the last few years. Now, every study done that I have read up to data around 2016, 17 showed exactly what we said. And we show that in the book. And even the Norway fund, one of the largest $1 trillion plan, did their own study and found that SRI type investing, it cost them over 1% a year. But then we had this massive shift that really took off in cash flows. So a good analogy I like to use is, you use this phrase, trades get crowded, or my expression of it is popularity is a curse when it comes to returns. So think about high-tech stocks or dot-com stocks in 1995. They hadn't outperformed the S&P in general or other industries, but then they became popular. Valuations went way up, not because of their earnings, just because of investor sentiment. And that meant future returns had to be lower. And eventually that bubble burst in March of 2000, and their stock prices crashed 70, 80%, and investors got hurt. So that's how popularity creates a problem. So the way to think about this is, in the last 5 years, we've seen massive inflows driving up the valuations of the green companies, and relatively speaking, holding down the valuations of the brown or sin stocks. And the best example I can give you is this study called Dynamic Equilibrium. So we're starting out with relatively low investment, say a few percent in ESG, SRI, and then all of a sudden there's a movement to this new equilibrium, and now we're already at, say, 40% or more globally, and it's probably, the research shows, survey shows, it's probably headed up to 80 or 90% over the next 2 decades. So now you got this trend, but we're in this transition to a new equilibrium. While that is going on, even though the brown or sin stocks have these higher expected returns because people dislike them, and actually they're riskier. They are subject, as we show in the book, to more environmental spills and lawsuits, consumer boycotts because of bad behavior, frauds because they don't have good risk controls. That's the G part. So ESG, regardless of the investment returns, definitely has less risk. So that's one bit of good news. So even though these brown and sin stocks, theory and evidence says, have higher expected, what we would call ex ante, before the fact returns, if you get enough cash flows coming in, you could swamp that 3% premium that existed before that. And in fact, from 2018 through 2020, this study, Dynamic Equilibrium, found that even though sin stocks had higher ex ante returns, ex post returns, the ESG stocks outperformed by 7% because
Yeah.
so much cash flow came in. Now, neither Sam nor I have a perfectly clear crystal ball. We only report what the evidence or from
Yep.
surveys is showing. If enough cash flows are coming in, you can certainly more than offset, as we've seen, that ex ante premium. Now, we don't know whether the trend is going to even accelerate or maybe it's peaking. We kind of think, maybe Sam can add to this, we're in the third or fourth innings of this transition. So we have maybe another 5-10 years before you get close to that new equilibrium.
Yeah.
And in that period, ESG investors or sustainable investors might be able to have their cake and more than needed to, because they're getting even higher returns maybe and lower risk of lawsuits, stranded assets, other things. So it's a really complex question, which when you review the research, you have to be careful to look at what periods they're looking at. If you just look at the last 5 years, you'll come to the conclusion that green stocks should outperform.
Right.
That cannot be right logically, at least in the ex ante sense, because if enough people prefer them, their valuations are higher, and everyone agrees they're less risky, and less risky assets should have lower returns, but that doesn't mean lower risk adjusted returns. I do want to add one other point, which is this. All of the excess returns to those sin stocks in that ex ante sense are well explained by what your clients know as factors like value, profitability, et cetera. So Dimensional, for example, is one fund family that has come up with a group of sustainable funds that says, here, we're going to tilt the portfolio towards the better green companies, but we're also within that portfolio, make sure the green stocks have more exposure, the ones we own, to the value profitability factors. So we can make up for that lack of premiums, restoring it. Now you get the higher return and you get to live your value. So that's really, I think the best news in the book is by combining the knowledge on factors with your values, you can really give yourself the best chance to achieve your goals.
And I'm glad you raised that, Larry, because that really forms the core of our sustainable portfolio too, is using that evidence-based approach with Dimensional, where we're getting the sustainability screens, but also we're including those factors, those small value and profitability factors.
And Michael, one other thing for your clients, Dimensional has a terrific series of funds run by the leading research firm, in the world. But we also have the ability for clients who want to express their unique set of values and build individual portfolios tailored to them. If you want to screen out and not own, say, energy companies, then Dimensional could do that. So can a firm called Parametric and Aperio. And on that, I'll throw one interesting point out. I'm going to recommend to people, do not make the mistake, at least in my opinion, a mistake, of screening out not buying energy companies. And I'll explain why. While they're, they do pollute, we want to make sure that companies have the resources to invest in technology that makes the world greener. And the very companies who people dislike from that perspective because of the carbon problem are the ones that are creating the most carbon patents, the most green patents to make the world more sustainable. So if you screen them out, you'll make their cost of capital higher, depriving them of the very capital you want them to be spending to make that transition to the green world. So what Dimensional does is it takes this best-in-class approach across industries. Sam, why don't you discuss Total, the French company, and how this best-in-class is an important way to think about things?
Yeah, I mean, I think of the whole sustainable transition really in a kind of market framework where you think of markets as a tug of war between the big companies that have earned dominant market share because they've had the best products and services of the past, right? And the innovative startups, the smaller companies usually who have the new products and services of the future. And that's a really simplistic way of looking at the world. But in our capitalist structure right now, the incumbents are heavily favored because they have a lot of power to protect their vested interests. You saw this with tobacco, right? You see it with big oil and gas. They have a lot of levers to pull, political, tax, others, regulations, where they can stay in their seat longer than they should because there's better technology coming along, right? And what we've seen over the last couple of years is that the world has kind of woken up to that. And they've said, we got to move money out of oil and gas because these guys aren't making the changes fast enough. Now, as Larry said, there's a problem with that because some of those guys, like that drilling technology, could be very useful for us for carbon capture and storage and all kinds of other things. So there's guys that are trying to change to move to the new world of a cleaner energy system. And there's the guys that are dragging their feet. And we, as investors, we shouldn't be indiscriminate in those choices. We should choose to say, hey, let's back the guys that are trying to make the transition, who are becoming energy companies and leaving the oil and gas company moniker behind. And there's a couple of companies like Total, the French company, and some other ones who are doing that. And I get that there's a choice investors want to make, say, I'm just not going to invest in any oil and gas. And then others will say, I want to cherry pick the good ones. The approach we want to do, right, that we want to take is back the ones, I think, that are making that transition.
Yep. I think that's right. And also, like the approach that we take to all of our portfolios, we really favor more diversified portfolios. So rather than, sometimes we look at funds or portfolios that are very concentrated only in a few companies, where we might not be getting the diversification that we're looking for long term. I want to back up a second and ask a couple more questions about impact. I'm thinking about, does it really make a difference? If I'm an investor and I choose to favor a sustainable investing approach, or favor investing in companies that are maybe more aligned with my values, does it really matter? And how do we know? And Sam, I wonder if you have any thoughts about that.
Well, I'll let Larry talk to the research, but I'll pick on him for a disagreement I have. He said the greatest news for the investors is that they can still invest for total return. I take that as a given. They can still have successful investments. I think the greatest news in the book is that the sustainable investment community is having huge impacts on corporate behavior, right? Yeah. So this whole movement is not like a tree falling in the forest that no one hears or sees, right? This is actually changing corporate behavior. Now, as an investor into real estate companies, because of our fund, the Global Sustainable Real Estate Fund, we've seen dramatic changes in the last 4 years in what companies are doing around climate change, around income inequality, around diversity. It's impressive. And they wouldn't be doing it if they didn't have at least the backing and the support of their investors. No CFO or CEO in the world would say, hey, we're going to do this crazy new ESG initiative, and our investors aren't really behind it, but we're going to do it. No, that they want to do it, and they turn around and they say, oh, a lot of our investors really want us to do this. Then they go full steam ahead with it. And I'll let Larry talk about the mechanisms and the research behind it, but trust me when I say that the companies are changing their behavior as more stakeholders, the investors, their boards, the regulators, their customers are asking them to be more sustainable.
Yeah, just jump. I'll certainly agree with Sam. His point here that investors who are acting sustainably and they're expressing their values through their investments are changing corporate behavior. And that's the good news, because as you'll see, it actually leads to higher returns, as we've already stated, but it also leads to improved profitability, One you could think of, if you become more energy efficient, you save costs. And I'm going to touch on another really important topic. But Sam and I thought this was so important, we devote a whole chapter of the book to how sustainable investors are in fact changing behavior, and cite a whole bunch of studies that are looking at this. So I think the easiest way for our listeners to think about this is to put themselves in the place of the chief financial officer and chairman of the company. And they see a company, let's say, as Sam mentioned, you're an energy company, you see Total that is getting higher ESG scores from the 7 raters. And so those higher ESG scores lead to more mutual funds incorporating them, more private foundations being willing to invest in them. Their debt costs go down, their PE ratios go up compared to the people who are getting the poor scores in their industries. So that means they're gaining competitive advantages, or at least not being disadvantaged against the competitors who are moving favorably. But it's not just that cost of capital story. What the senior officers of the companies are becoming to recognize is, especially with the millennial generation, they want to work for companies that express their values and live them. And what the research is clearly showing is that corporate behavior is driving employee satisfaction. So the people want to work for companies who are green, socially responsible, care about diversity, et cetera. Those companies attract more talent, number one. Those employees are more satisfied. They have lower turnover, which leads to a lot lower costs. But happier employees, the research is very clear, leads to higher productivity, which is more profitable. So there's this virtuous circle that Sam and I think is really going on. And that can make sustainable investors feel really good, because the companies who are not acting, positively are going to be put at a competitive disadvantage and in effect be forced or dragged along, or they'll just go out of business or suffer because they're not acting. So we're seeing this positive trend without a doubt.
And it's not only you guys focused on, rightfully so, on climate change and some of the environmental factors, some of the environmental issues, but we also see it in terms of gender equity, for example, representation on boards and in senior management, and even pay equity. We see the impact that investors are having on companies from that perspective by bringing initiatives to boards and creating, asking for more, demanding more transparency from companies. So we're seeing that too. I assume you guys recognize and see some of that activity as well.
So yeah, there's a great paper, Can Sustainable Investing Save the World? And they talk about the 3 mechanisms for driving that change. And the one that a lot of people focus on is that capital cost of capital change. When money flows into the companies, they're, like Larry said, their PE ratios change. That's easier for them to get debt financing. That's a big one. The second one is the shareholder engagement, right? So for example, all the REITs that we invest in, we communicate with them every year, and we say, we want you to do, tell us about your climate risk. We want you to tell us about your diversity in your employment, in your management and your board. We ask them for a lot of things, and a lot of investors are now asking companies for more. So that shareholder advocacy and engagement piece is a big piece. And then the third piece they call indirect, and it's kind of a grab bag of several different effects, but think of it as stigmatization or endorsement or benchmarking.
Yes.
The brands, what happens to the brand when they become known as a leader versus a laggard, and how that affects things like their standing in the community, the desirability of their products, their ability to get things done. That's a big part of it too. And so all those 3 things come together to get companies to change.
Yeah, it does make a difference. And certainly when we see clients who express an interest and want to align their money with their values, it's helpful to know that they are in fact making a difference.
I like the way I describe your individual action, right, is the following. There's a tension here between your individual action and collective action. Like when you recycle, right, that's one thing, right? Or when you ride your bike instead of taking your car, that's one thing. And investing sometimes feels like it's an individual action. I'm moving my money. But when you put your money in an ESG mutual fund or an ETF or portfolio or with an advisor that does this, you're joining a growing cohort of investors who are clamoring for that. And when the CFO or CEO turns around to see whether his investors got his back, the numbers that he's looking at are not individual investors. He's like, what's that pile of investors? That pile of investors, like we talked about, is now 1/3 of all investors in the US and growing, only 20% just a couple of years ago. And so they're saying, oh, right, so you're joining that collective force, and you're getting your fund manager, if you get into a fund that does shareholder advocacy, to use that bully pulpit, if you will, to be a voice for change.
Yeah, I think it's so important for people to recognize that and hear that, because I think people wonder a lot if they're actually making a difference. I want to remind the audience that you can post questions, post your question in the chat, and we'll be able to pick it up. You've got a couple of real experts here in sustainable investing, and the authors of Your Essential Guide to Sustainable Investing, with a new book that just came out. And for those that have an interest in a copy, we can get you a copperleaf version of that book, and are happy to share that. I want to turn to greenwashing. And what I mean by that is you hear it in the press, and because this has become so popular, lots of people have kind of jumped on the bandwagon. And how does an investor know? How can an investor tell, if somebody puts a green label on a mutual fund? I mean, nobody's gonna, is there a law that says you can't say, the green oil company fund? I don't know. But I think this is a thing. Sam, can you chat about what is this whole greenwashing?
Well, first of all,
about?
This might sound strange, but I love the greenwashing criticism. Okay. And that's because I was in the trenches with YouTube back in the active versus passive days, right? Mm-hmm. And I remember in the early 90s, the active managers just laughed us out of the room. They didn't even address us. They're just like, that's ridiculous. And they'd move on. Right. Right. But then they started coming up with objections to implementation, right? They couldn't fight the argument. So they started, well, actually doing it is kind of hard, right? Like, and so they'd come up with but that means they tacitly accepted the fact that what you had was good enough to scare them, right? And this is what's happened with greenwashing. Now that they used to dismiss ESG out of, that's ridiculous. And now they're like, well, yeah, it makes a lot of sense. But it's hard to implement because you don't really know who's truly ESG and who isn't. I'm like, okay, well, that's great, but we're making progress here. And it is difficult because, but before I get to, also, color me surprised, right? Oh, companies are putting themselves out in the best possible light. They got pictures of couples golfing on their annual report, and now there's windmills in the background. I mean, this, I'm going to outperform and be green. I mean, this is all the same stuff, right? So caveat emptor, like your job as an investment advisor is to protect your clients from this stuff, right? And your job as the audience, the investors, is to be aware and have your skepticism and your hat on, right? And so you need to use the tools that are becoming available now to sort the wheat from the chaff, and that does take extra due diligence, and there are more tools to do that now. It reminds me of when all the food companies started slapping the natural label on everything. Like, it sounds good, but doesn't mean anything at all. Right. Make sure that you get what you're looking for.
Yeah, Michael, I just add briefly to Sam's insightful comments. We report on this in the book that evidence is clear. There is greenwashing going on because Wall Street firms recognize the huge amount of capital flowing in. They want to capture it. So they changed the name of the fund from the XYZ fund to the XYZ Sustainable Fund or Green
Right.
Fund or
Right.
whatever. And they don't change their behavior. And a recent study found that actually there was either no change or they even got worse scores after putting their names on. So it is really important to do one of two things, or one of three things. As an individual investor, you can do that due diligence. You have to dig in and read the mutual fund reports and get into the weeds in those 150-page documents. Or you can work with someone like yourself, Michael, and Buckingham, where we have done that work to make sure it's done. Or the third option, as we discussed earlier, you could just build your own portfolio with your own unique criteria. And that has become, you don't have to be a multi-million-dollar investor to be able to do that. Portfolios can be built individually within the hundreds of thousands now, not tens of millions, and at reasonably low costs as well.
Yeah, we really like that approach, and more for our clients that do want to really fine tune the approach and screen out specific industries or companies. We really like that approach and like being able to do that.
Here's, again, I want to touch on this, but I want to point out that the separate managed accounts actually have a second advantage, which is if it's taxable dollars, that gives you some additional tax efficiencies, which can swamp the extra costs, which may only be 10 to 20 basis points of creating a separate management account today, whereas a decade ago or more, it would have been a lot more expensive to do that. But the second point, again, is to be very careful before, at least how you think about what you want to screen out. I gave an example of not, in my opinion, you shouldn't necessarily screen out energy companies, but if they're doing the right things and putting their capital to make the world greener. But another example is some people just automatically screen out nuclear energy, when nuclear energy is probably as efficient, much cleaner than anything else we have today, and is the short term clearly the best answer. And so you really want to think about, do you want to screen industries out? No right or wrong answers. It's your own personal opinions, but you really need to think deeply, maybe have a discussion with your advisor asking, am I thinking about this the right way? By screening them out, am I actually accomplishing the objectives that I want?
Yep. No, it's true. And it's amazing how everybody has their priorities and points of view. And we try to take that into account and help people be fact-based, but also support their values, their individual values too. It's important. It used to be, kind of back to history and the discussion about history. Sam, it used to be that they would say, I can't remember where this came from, but make as much money as you can with your investments and then donate to charity to kind of follow your values. But are you finding that perspective has changed, or is it kind of supported? How does it line up with sustainable investing, you think?
Well, in full disclosure, I said that for years, right? So from in the 90s and the 2000s, I was like, that's SRI stuff. If you really feel strongly about it, but you're going to sacrifice returns. So another approach, and we just by excluding those companies, if that's all you're doing, you're not hurting them. As Larry said, don't buy their products, right? That hurts them. But taking your money out of their stocks doesn't do anything. That was SRI. But then when ESG came along, he said, okay, well, hold on, I can have an investment strategy that doesn't underperform my conventional one. Okay. And it does have impact on corporate behavior. That really changes the answer to that question, right? And you're like, right. Well, I'm going to put this money somewhere. I have capital to invest. I have to put it somewhere. And I have a choice between conventional or ESG. And I can make it so they have similar returns, and this one has impact. Then it's not either invest or philanthropy, then it's both. Then you're
Right.
saying, I'm going to take my entire financial life and I'm going to structure it around the things that I care about. And so people are doing things like, I'm going to move to an ESG portfolio. I'm going to keep giving to charity. I might add some impact investments in my donor advised fund. I'm going to change my bank because I don't like the big corporate bank. I want to go to a local credit union. I'm going to start shopping differently. There's all kinds of things. And so the way I think about it, and so I've always been an environmentalist. I've always been trying to make sustainable choices. And when ESG investing came along, it just gave me another choice in a frankly quite large part of my life. My financial capital, right, is a big part of my human capital. And so now it's like, I can still ride my bike, right? I really can't fly organic yet, but I can put my money to work for good. And that feels great, because here's the thing. It's in The Economist, it's in the Wall Street Journal, it's in the New York Times. People realize that their money, okay, is funding deforestation, is funding drilling, is funding climate change. And they'd like to be less of a part of the problem and more a part of the solution. And this does that.
Sam, why don't you just take a minute and describe the impact investing, maybe give a couple of examples for people who want to directly impact things they care about.
Yeah, good point. Thanks, Larry.
Philanthropy is fantastic, right? It's such a wonderful thing to do. But a lot of wealthy philanthropists, which the really wealthy guys probably made their money as entrepreneurs, right? The Carnegies of the world, now the Gates and things, they realize that sometimes giving money to a nonprofit is not the best way to solve one particular issue. It doesn't scale, and you keep having to send more and more money every year. So it's kind of like a welfare system. That's great for some problems that there's not an alternative, but some other problems are better served by putting in companies, giving catalytic capital to a company and go solve that problem. For example, how would you want to distribute smokeless cook stoves in sub-Saharan Africa? Do you want to give them away and then try and figure out how to maintain them, or how does that work? Or do you build like a multi-level marketing system where the local villagers can sell them and maintain them and build businesses? Well, that's a much faster, much more scalable, much more resilient way of doing that problem. And so some people have said, I'm going to take some of my philanthropy capital or some of my conventional capital and put it into impact investing. And the cool thing about this is it's very direct to the specific problem or issue that you want. You say, I want to relieve poverty in inner cities in the East Coast of the U.S., or I want to fund, get girls going to elementary school in, India. Whatever, you want, you can now find those things. Now, there are usually private equity or private debt, so they sometimes can be more difficult to implement than public market investments. But that feeling of actually changing things on the ground is a really, really strong feeling. I sent a bunch of money to a village in Peru. Not a lot of money, I shouldn't say, a bunch, but
to them it was a lot of money though, Sam.
That's the thing about the impact, right? It was a couple grand for me, but it helped that village certify all their coffee beans as organic, which means they could immediately command higher prices. And so it just felt I love organic food and organic coffee, so it's right up my street, and it changed the game for that village.
Well, and selfishly, here in Vermont, there are numerous ways that people can invest locally with impact investing too. I was just asked to join the Vermont Community Loan Fund, and here's an organization that's making small loans to disadvantaged populations to start small businesses, and also supporting affordable housing and childcare with a community loan program that's been very effective for the last 30 years. So there are lots of ways that people can engage in impact investing, even with their donor advised funds. And you talked about the alignment there. One of the things I love about the ability to invest sustainably and support philanthropy is, using a donor advised fund, the investments in the donor advised fund can also be aligned with your sustainable portfolio and your sustainable approach. And you can actually make loans through your donor advised fund that can have impact for specific nonprofit projects, and have that money, circulate within the community and back to you as a low interest loan. So lots of really exciting things that people can do to have impact and align their money with their values. Well, let's get back to the book. And so the book just launched earlier this month. Are you getting getting some sales and getting any reviews on Amazon? And what can people do to get a copy of your book? I know that for the folks on this call, we're happy to provide a book if they're interested, but can people find it on Amazon, or how would they find the book?
Absolutely. Find it on Amazon. Now, interesting thing with our book, you have to write a review before you buy it. That way, no, I'm just kidding. Do buy it on Amazon. If you just Google your essential guide to sustainable investing, it will come up. But if you do like it, please do write a review. The book is selling well because of it's one of the few in this space, and we've got it actually even being translated into Chinese and into Dutch. Wow. And so yeah, we're excited about its prospects in getting the word out that sustainable investing is something that you can do to live your values and achieve your financial goals.
Well, we're thrilled to be able to support the work that you guys have done in putting together this book. We think it's meaningful, will have impact on its own, helping people learn more about sustainable investing and all the history, and also some of the data, the facts, what the research shows about sustainable investing. Just a reminder to those of you that are on the call, if you have a question, drop your question in the chat box. Happy to get it addressed. One of us will be happy to address it. What's the future look like for sustainable investing? And Larry, you talked a little bit about the kind of the economic theory, but any other trends that you see that you're willing to kind of dust off your crystal ball a little bit? And
well, one I think is just, let me say it this way. While I almost always say my crystal ball is cloudy, there are, on rare occasions, my crystal ball becomes pretty clear. One of them was when I started writing my first book about index or passive or structured systematic investing. I said, this trend is coming. There's nothing that can stop it. There's an old line that there's no army strong enough to stop an idea whose time has come. And sustainable investing's time has come. And I have no doubt that this trend is going to continue. It's accelerating. And we just don't know how fast it takes to get to that new equilibrium, which at some point 80, 90, 95% of the dollars will be invested sustainably. So that is one thing that I think we can say is going to happen. And that's going to help at least the short-term returns to sustainable investors as they benefit from the cash flows, and it penalizes the brown companies, which will force them to change and act like better corporate citizens. Right. But eventually, if 90% of the world is, investing sustainably, sin premiums are going to have to rise. Now, the good news is maybe there won't be a lot of sin companies left because they have such high cost of capital, they can't compete. Yeah. The second thing I think you're seeing is much more pressure on transparency of corporations. I'll let Sam touch on this. But for example, we used to only see companies reporting typically on what are called Scope 1 emissions. What goes into your products that you're making? Now you're seeing many more reporting on Scope 1 and 2, which is all the inputs, like the energy you use to make your products, and the supplies that go into before you even get to it. But there's almost none, although you're starting to see some, what are called scope 3 emissions. So think of Amazon, which I don't know if this is true, but just say they use all renewable energy to power their plants. And so they get this high score, but no one counts the trucks that are driving around your neighborhood using gasoline, probably to deliver. So if you include scope 3, someone might say they're really a poor company on that. So there are accounting standards. Sam can talk about the sustainable accounting standard boards that are coming in and trying to impose standards and what have to disclose. So I think we're going to see a lot more transparency by both industry, and I think likely the mutual fund industry is going to be forced by the SEC. Sam, why don't you add your comments?
Yeah, I mean, if we were relying solely on people being nice, being better citizens for this revolution in sustainability, we might see it slower or be in trouble, right? Because greed is kind of a powerful force as well. So, you never know. But what I didn't move my career into this until I had answered this question satisfactorily in my mind. And what Larry just touched on is key. Markets are voracious for information, and they will demand more and more from companies so that we can get a better handle on what their risks and opportunities are. And even investors who do not care, don't have a sustainable bone in their body, want to know, oh, you have lots of pollution that could become costly. You could face a fine. You are sited in a dangerous area because of climate change, because of sea level rise, because of droughts. That could become an issue. That kind of information, which we haven't had in the past, is now flooding into the markets, getting better quality and more transparent. And the markets will demand that no matter what. So the combination of that and people wanting to do more good with their money means that this ESG, as Larry said, is going to become more and more part of the investing landscape. And like you said, maybe reach 80 or 90%. Now that's really good news, because then capitalism, one of the strongest forces on the planet, will be pushing companies to do more with less, okay, and to innovate faster, okay, and take less risks with our planet and with people. And that is just that's why I love getting up every day and working in this field, because we're really changing. This is the next evolution in capitalism, and I'm excited for it.
Me too. And it works. Like you said, it's amazing that it just works and it makes so much sense. And I'm so glad that we're able to kind of be in this time where people can express their values, align their money with their values, and kind of get on this train while it's moving now.
Yeah. So Michael, all your listeners can help this trend by getting on that bandwagon, reading our book, recommending it to friends so that they see the benefits, that it's not fruitless. So what am I doing individually? You can join this collective movement that is changing the world. So please read the book, recommend it to your friends, have them write reviews, get other people to want to read the book, and that'll all help us all make the world a better place.
Yeah, thank you guys. We're getting to the end of our time. For those that are on the call today, if you'd like a copy, just let us know, send us an email. Our boxes actually haven't arrived in the office yet. I'm looking forward to our boxes of copies arriving, so I think they'll be here any day. But we'll be happy to send out a copy to those that are on the call.
And you'll even autograph it for them too, Michael. Right?
Absolutely, yes. Thank you, Larry and Sam, for joining us today. Thank you, audience. We have another town hall session coming next month. We're going to be talking about estate planning and your digital assets, how to protect your digital assets. So thanks everyone for joining us today, and have a fabulous rest of the day.